Welcome to Money Depth Insights. I am the finance guide, John Nell. Today, we are going to talk about loans, explained in simple words, not as financial products on paper, but as real tools that affect everyday decisions, long-term stability, and the way people experience money over time. Most people think of loans as either helpful or dangerous. Some see them as opportunities. Others see them as traps. In reality, loans are neither good nor bad on their own. They are agreements. What matters is how they are used, why they are used, and whether the borrower understands what they are trading today for relief, access, or growth tomorrow. At their core, loans are about time. A loan allows you to use money now that you do not yet have, in exchange for paying it back slowly over the future, usually with an added cost. That cost is not a punishment. It is the price of accessing time early. Once you understand this, loans stop feeling mysterious and start feeling logical. The biggest mistake people make with loans is thinking only about approval. They ask, "Can I get this loan?" instead of asking, "What does this loan change about my future?" Approval feels like success. Repayment is where reality shows up. Loans exist because life does not move in a straight financial line. Income comes in cycles, while expenses often arrive all at once. Education, homes, businesses, emergencies, and even short-term cash gaps create situations where waiting is not practical. Loans bridge those gaps. The problem begins when loans are used to solve emotional discomfort instead of structural issues. One important distinction is between productive loans and consumptive loans. Productive loans are tied to something that has the potential to improve future earning power or stability. Education, skill development, or well-planned business investment often fall into this category. Consumptive loans are used for things that disappear quickly, like lifestyle spending or impulse purchases. The same loan structure behaves very differently depending on what it supports. Interest is the most discussed part of loans, but it is rarely understood calmly. Interest is not designed to scare people. It exists to compensate the lender for risk, time, and opportunity cost. What makes interest dangerous is not the rate alone, but duration. Small interest over a long time quietly becomes expensive. People tend to underestimate this because the early months feel manageable. Another common misunderstanding is focusing on monthly payments instead of total cost. A lower monthly payment feels comfortable, but it often means the loan lasts longer. Longer duration increases total interest paid. Comfort today often costs more tomorrow. This trade-off is rarely explained clearly, but it matters deeply. Loans also affect behavior in subtle ways. Once someone takes on a loan, future choices become narrower. Flexibility decreases. Decisions that once felt optional become necessary. This does not mean loans should be avoided. It means they should be chosen with awareness of how they shape freedom. Many people use loans to fix cash flow problems instead of fixing the cause. Credit cards, personal loans, and short-term borrowing often become substitutes for budgeting, savings, or income planning. At first, this feels relieving. Over time, it creates dependency. When loans are used repeatedly to smooth everyday life, stress builds quietly. Another observed pattern is optimism about future income. People often assume that earning more later will make repayment easy. Sometimes that happens. Often it does not happen as expected. Loans made with optimistic assumptions become heavy when reality changes. This is why conservative planning matters more than confidence. Collateralized loans, like home or auto loans, introduce another layer. These loans are tied to assets. If payments fail, the asset is at risk. This structure often lowers interest rates, but raises consequences. People feel safer because rates are lower, yet the stakes are higher. Understanding this balance is essential. Unsecured loans, on the other hand, rely purely on trust and credit behavior. They usually cost more because the lender carries more risk. This is why credit history matters. Loans are priced not only on numbers, but on predictability. One of the most overlooked aspects of loans is emotional weight. Debt changes how people think. It can create pressure, urgency, or avoidance. Even manageable loans can feel heavy if they were taken without clarity. Calm borrowing feels different from reactive borrowing. Loans also interact with opportunity. A manageable loan can enable progress. An overwhelming loan can block future choices. The difference often lies in margin. Loans that leave breathing room support stability. Loans that stretch budgets tightly increase fragility. Another real-world insight is that loans rarely fail people suddenly. They fail slowly. Payments are made. Balances move down. Then something changes. Income shifts. Expenses rise. Stress increases. The loan itself did not change. Life did. This is why resilience matters more than optimism. People who handle loans well usually do a few simple things consistently. They borrow less than they are approved for. They understand total cost, not just monthly cost. They leave space for uncertainty. They treat early repayment as flexibility, not obligation. Loans can also be tools for leverage when used carefully. Businesses, investments, or education financed responsibly can multiply effort. But leverage magnifies mistakes as easily as it magnifies success. This is why loans require humility, not confidence. Another key point is that loans do not fix financial habits. They amplify them. Organized people remain organized with loans. Disorganized people struggle more with loans. Borrowing does not create discipline. It reveals it. Over time, people who build wealth tend to use loans strategically, not frequently. They borrow with intention, repay with structure, and avoid using debt to support lifestyle inflation. Their loans serve plans, not emotions. The healthiest relationship with loans is neutral. No fear. No excitement. Just understanding. Loans are tools that move resources across time. When time is used wisely, loans support progress. When time is wasted, loans become burdens. Ultimately, loans are agreements with your future self. They assume that future you will be able, willing, and stable enough to honor today's decision. Respecting that future version of yourself is the foundation of responsible borrowing. If this explanation helped you see loans more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Nell, and I will see you in the next session.